Smart money just repositioned over $3 billion this week. Retail traders are completely oblivious to this massive institutional rotation. Walk away now and you'll miss the real story.
95,000. That's the impending non-farm payroll forecast. It's a massive, catastrophic drop from last month. Retail algorithms are pricing in severe US dollar weakness right now. The masses expect a total dollar collapse. But listen, you're looking at the wrong data points entirely. The real narrative is completely hidden. Institutions use obvious data to create retail traps. They actually want you focused on that weakness. Meanwhile, they're quietly accumulating massive risk-on positions. The mainstream media pushes the panic narrative, right? While professional traders ignore the noise completely. We track the silent footprints of smart money. We focus strictly on liquidity manipulation. The true macro picture tells a totally different story. Retail traders are buying this move blindly, but institutional flow is telling a completely different story. Market makers are intentionally engineering a massive trap. They want retail to short the dollar early. They desperately want you entering the market prematurely. See, they hide their massive capital rotation in plain sight. Let me expose exactly how they operate. Institutions never move size without leaving a trace. They require vast amounts of counterparty liquidity. When retail buys, smart money is selling. When retail panics, smart money accumulates. This entire week has been a masterclass in manipulation. They're building a massive algorithmic trap right now. You must learn to read the institutional footprints. Otherwise, you literally become the liquidity they need.
Now, retail completely ignores the commitment of traders report, but we translate this data into actual institutional behavior. Smart money is aggressively accumulating the New Zealand dollar. They're simultaneously unwinding their US dollar longs. The Japanese yen and the euro, they show heavy net shorts. Institutions are using the yen to fund risk-on positions. They're using ERJPY as a massive funding vehicle. This is textbook institutional capital rotation, guys. The euro and yen are fundamentally weak right now. Smart money borrows them at near zero effectively. Then they use that capital to buy high-yield risk assets. The New Zealand dollar offers massive fundamental yield. The Australian dollar acts the exact same way. They're squeezing retail shorts out of existence. This rotation creates violent and sustained macro trends.
The extreme downside volatility in safe havens is glaring. Look at this. The VIX is crushed by over 23%. Crude oil plummeted over 16% just this month. This signifies a violent macroeconomic shift. Risk on is the absolute dominant theme right now. Capital is aggressively fleeing safe havens entirely. Smart money is actively hunting for high beta yield. They're positioning for a massive macro expansion phase. Volatility compression always precedes massive market expansion. The fear gauge is effectively broken right now. Retail is terrified of an impending market crash, but institutions are buying every single deep discount available. They're absorbing massive sell-side liquidity pools. The macro environment is perfectly primed for risk assets. You cannot fight a multi-billion-dollar capital rotation. You simply must align your portfolio with institutional intent.
This relative performance data exposes the absolute truth. The New Zealand dollar just surged over 2%. Meanwhile, the Japanese yen remains entirely suppressed. The euro is equally weak across the board. Institutions are relentlessly buying the strong macro assets. They're simultaneously shorting the weak funding currencies. This is exactly where smart money hides their volume. The rotation into NZJPY and EURJPJPY is undeniable. Capital flows always follow the path of least resistance. The Japanese yen offers zero fundamental support here. The euro is crumbling under terrible economic data, but the New Zealand dollar is experiencing a massive bid. Institutional algorithms pair the strongest against the weakest. They create massive asymmetrical trading opportunities. This divergence is exactly what professional traders hunt for. We just let the institutions do the heavy lifting. Next week is a maximum impact week. We face critical ISM data and non-farm payrolls. Institutions know these NFP estimates are incredibly low. Listen, professional money does not gamble on the news. They adjust their complex portfolios days in advance. They engineer price runs to fill their massive orders. They reposition their billions before the news even hits. Retail waits for the print and gets completely crushed. The news is merely a liquidity generation engine. It provides the volume needed for smart money execution. High-impact news creates massive emotional volatility. Retail traders trade the reaction. Institutions trade the preparation. They know exactly where the massive liquidity rests. They will drive price aggressively into those specific levels. The news simply acts as the ultimate catalyst. The psychological disconnect here is absolutely fatal. Retail sees an overbought RSI indicator. They falsely assume the market must reverse immediately. They start aggressively shorting the primary trend. That is a very dangerous and costly retail bias. Institutions do not care about overbought momentum signals. They use your retail stop losses as their liquidity. They're actively hunting for higher external liquidity pools.
Your hard stop loss is their prime entry point. Retail trades against the massive algorithmic macro trend. Institutions simply ride the wave of internal liquidity. They manipulate internal pricing to hunt external stops. This is the core principle of smart money concepts. The market is not random or chaotic at all. It is a highly engineered liquidity delivery matrix. Let's surgically dissect the NZJPY 4-hour structure. Retail traders see useless lagging moving averages here. We see pristine institutional order flow. Notice how a clean fair value gap perfectly holds price. An unbroken bullish order block rests right here. Aggressive internal liquidity sweeps occurred just below. Smart money creates these minor pullbacks to trap sellers. They're engineering massive sell-side liquidity pools. They'll use this to target external buy-side liquidity. The market is constantly moving from premium to discount. Right now, we're resting in a deep discount. The algorithms have perfectly balanced the price delivery. The sell side has been completely purged from the market. Now the ultimate draw on liquidity is higher. The external macro highs are acting like a giant magnet. Based on this macro flow, we execute immediately. Our primary bias is unequivocally long today. We are aggressively buying NZJPY. Our entry zone rests at a deep discount array. We enter between 93.8 and 94.6. Our hard stop is placed safely at 93.2. Target 1 sweeps internal liquidity at 95.3. Target 2 takes the massive macro high at 96.5. We only execute when the COT data aligns perfectly. We demand multiple confluences before risking capital. The fair value gap provides our precision entry criteria. The order block acts as our institutional sponsorship. This is a high probability institutional setup. We let the algorithms push us straight to target. A decisive 4-hour close below 93.2 entirely invalidates this institutional long bias. Professional traders demand absolute macro confirmation. The AUD-USD 4-hour timeframe provides this exact macro confirmation. Institutional order flow is cleanly bullish here too. We see a massive, undeniable draw on liquidity. Smart money is attacking the exact same macro pools. They're synchronizing this move across all correlated pairs. The Australian dollar mirrors the New Zealand dollar flow. Both are destroying weak funding currencies entirely. This alignment guarantees the integrity of our primary bias. When massive institutions move capital, they leave footprints everywhere. We track these footprints across the entire foreign exchange matrix. The algorithms are perfectly coordinated right now. The draw on liquidity is undeniably pointing higher. Those external highs are absolutely doomed. So here is your professional execution logic. First, never chase massive green expansion candles. Wait patiently for a minor distribution shakeout. Let the retail traders panic and sell early. Enter your long positions strictly at a deep discount. Let price sweep internal liquidity first. Then seamlessly target the external liquidity pools above. Stop trading blindly based on retail emotions. Start tracking the underlying institutional liquidity matrices. You really must think exactly like a market maker. Protect your capital with ruthless precision. Always buy discount and always sell premium. This is literally the only way to survive the markets. If you're only reading candles, you're blind. You're only seeing half the story. Write this power insight down right now. Retail traders react to price. Institutions react to liquidity. Price moves toward liquidity, not towards your opinion. Master this, and your entire trading career changes. Price action without liquidity context is completely useless noise. Stop obsessing over lagging indicator crossovers. Start studying the architecture of institutional order flow. The massive pools of resting orders dictate absolutely everything. Learn to identify the true draw on liquidity. Secure your institutional edge today. To follow future trading opportunities and detailed market breakdowns, you can open your trading account using the link in the pinned comment. Subscribe to this channel right now. Leave a comment below with your macro thoughts. Protect your capital out there. Trade safe. I'll see you in the next explainer.